Inflation is eating your lunch, your savings, and probably your retirement plan, but what if the meal was actually on the table for you this whole time? We need to talk about how the very monster destroying your purchasing power might actually be the best thing that ever happened to your portfolio. Most people hear the word inflation and immediately picture grocery receipts that look like phone numbers. But equity investors who understand the game see something completely different. They see a transfer of wealth, and the question is simply which side of that transfer you want to be on. Here is the core mechanic that almost nobody explains clearly. When prices rise across the economy, companies that own real assets, pricing power, or irreplaceable infrastructure get to charge more while their debt stays fixed. It is like borrowing $10 to buy a sandwich shop, then watching the price of every sandwich quietly double while your loan balance never moves. Think about what happened in the 1970s. One of the most brutal inflationary decades in modern American history. The S&P 500 actually delivered positive nominal returns for investors who stayed disciplined and diversified. Meanwhile, the person holding cash in a savings account watched their purchasing power quietly evaporate like a puddle in a Texas summer. The companies that win during inflation are not random. They follow a very predictable pattern involving pricing power, hard assets, and low debt sensitivity. Energy producers, commodity companies, real estate investment trusts, and consumer staple giants with brand loyalty can raise prices without losing customers, which is the closest thing to a financial superpower that exists. Now here is where the irony gets delicious. The Federal Reserve raises interest rates to fight inflation, which temporarily punishes growth stocks and sends investors screaming into panic mode. But historically, value-oriented equity positions in sectors with real asset backing actually strengthen during these tightening cycles because the underlying earnings power is tied to the physical world, not a spreadsheet dream. There is a common misconception that all stocks suffer equally during high inflation, and that belief causes ordinary investors to flee to cash at precisely the wrong moment. The data from every inflationary cycle since World War II shows that equities, over any rolling 10-year window that included high inflation, dramatically outperformed bonds and cash as a store of real wealth. The behavioral trap is even more dangerous than the economic one, because when headlines scream about rising prices, our lizard brain interprets that as a signal to hide. But every legendary value investor, from Benjamin Graham to Warren Buffett, built generational wealth by treating market fear as a clearance sale rather than a fire alarm. Practically speaking, you want to think about tilting your portfolio toward what practitioners call real return. Assets, commodities, exposure, energy, equities, inflation-protected dividend growers, and yes, real estate in some form. You do not need to go all in on any one theme. Even a modest reallocation of 20 to 30% of your equity exposure toward inflation-benefiting sectors has historically smoothed out the rough patches significantly. Position sizing is everything here, and that is the lesson most people skip because it is boring compared to picking the hot ticker. Putting 5% of your portfolio into an energy ETF during an inflationary cycle is a smart hedge. Putting 60% in because you are convinced you cracked the code is just a different flavor of speculation with better sounding vocabulary. The process matters more than the prediction, and that is the uncomfortable truth that sits at the center of every serious investing framework. You do not need to forecast whether inflation will hit 4% or 7%. You need a systematic process that benefits from inflation when it arrives and does not blow up when it retreats. History rhymes rather loudly here. The 1980s brought disinflation. The 2000s brought commodity supercycles. And the 2020s brought the fastest inflation spike in 40 years. And in every single episode, the patient equity investor who owned the right businesses came out ahead of the person timing the macro call. The volatility felt different each time. The headlines felt unprecedented each time. But the underlying mechanism was the same transfer of purchasing power from savers to owners. At its deepest level, this is a philosophical argument about what money actually is and what ownership actually means. Owning shares of a company that sells essential products or sits on irreplaceable resources is, in the most literal sense, owning a piece of the real economy and inflation. for all its pain, is ultimately just a measurement of how that real economy is pricing itself. Discipline, consistent process, and rational position sizing will always outlast brilliant timing and maximum conviction that is not motivational poster talk. That is just the compounding math working exactly as advertised. Whether inflation keeps running hot, cools off faster than expected, or does something completely unexpected, the equity investor with a structured framework and real asset exposure is genuinely comfortable with any outcome because the preparation was sound regardless of the result. If you want help building that kind of framework through real estate investing, connecting with reliable contractors, or finding the right lending partners to make your first or next move, check out our links in the description below.